Hey everyone, how's it going? So today I thought I would give an update on our cash secured put scan that I post every week. I haven't given an update in a number of weeks. Actually, I think it was July was the last update that I gave. And July was actually the last week that we had a losing week. Since July, the scan has been profitable every single week until this past week, which was October 1st. And most people are going to say that the reason that the scan did bad this week is because the market is down. But if we actually look at the scan, 78% of all the contracts that we found expired worthless. We only had about 4 to 5 stocks that actually really hurt us. And really, it was one stock that hurt us a lot, and that was Moderna. And I actually kind of gave a note in the comments here. I don't do often, but I said, even though we had a successful week picking stocks, the overall account dropped because Moderna had a 3 standard deviation move to the downside, and this wiped out roughly about 3 to 4 weeks. I don't think it was actually 3 to 4 weeks. It was closer to 2 to 3 weeks worth of gains. On a monthly basis, it still finished up a little bit, but if we want to look at some of the losers, we did have some small losers up here, but they weren't really anything. The big losers, like I say, were Moderna. And then Snap, TQQ, and Upstart were pretty bad losers as well. And if we want to look at each of those, we can see that Snap, you could have sold for 86, and you would have had to buy that back for 465. So that's a loss of 379. And this is if you bought it back at the end of the week. If you decide to get assigned, you could get assigned and try to sell covered calls here. But I'm just for the purpose of this, I basically just open and close every week just to see how well this works. And so far, it's worked really well. TQQ is another. You bought between 130 and 160, depending on what contract you chose. And you had to buy them back on Friday between $8 and $9. And then Upstart was the other one. You bought it at 450, had to buy it back for 10. So that was a loss of $6. But the big loss came from Moderna. I keep saying bought. You sold between 4 and 6 and had to buy back between 63 and 73. And if we multiply the contract sizes by 100, so this we sold for 530, we had to buy this back for $6,800 right here. So that's a very big loss. And if we want to look at the chart, we can just see how bad this week was for Moderna. So the white lines are basically the expected move for last week, plotted higher or lower. So Moderna had roughly a $23 to $24 expected move. So that means the 1 standard deviation expected move, it had about a 68% chance that it would stay within this range. And for the most part, it kind of does a little bit. We had a week right here where we were outside of it, but for the most part it stays in. This was another week we were outside, but we came back in. But anyway, we can see that on the week the stock opened and then closed Monday afternoon pretty much right on the expected move. Then Tuesday we opened outside of it and dropped, and then Wednesday and Thursday we kind of stayed in the same range here. And then on Friday, news came out that another pharmaceutical company came out with a pill for the coronavirus. So that hurt all of the coronavirus shot manufacturers. Or I'm assuming it hurt the others. It's obviously it hurt Moderna right here because it had another drop. So even though we had a $23 to $24 expected move, higher or lower, Moderna actually closed the week down $90. So this was over a 3 standard deviation move. And when a stock moves that far, even if you sold a 5 delta here, you would have gotten run over. If you tried to do a credit spread for a 5 delta, you would have been run over here. You would have most likely taken a max loss even at a 5 delta credit spread, because I want to say that the 340 here, 345, I want to say was a 2 delta, and 340 was a 1 delta. So even if you sold a 2 delta put here, you would have been assigned by selling the 2 delta put, which would have been roughly 98% chance or probability of being out of the money. So with that said, what can we I guess what could we look at here that would tell us, maybe not to trade this? If we look at this stock just year to date since January on a percentage basis, as of last week, the open on that Monday, the stock was up 284% on a year to date basis, which is already huge. So maybe that will tell you not to trade it. I don't know. One thing that tells me not to trade this is because it is a pharmaceutical company, I try to avoid these stocks. Even though I trade a lot of high implied volatility stocks, you already know that move is already priced in, so you are getting paid for that risk. On this, the pharmaceutical companies, you're getting paid for some of that risk, but this stock has roughly a 70% implied volatility, and it moved 3 times what it was supposed to move. So just the fact that it's a pharmaceutical company is something that keeps me from trading it, but that may not stop everybody. I do trade them occasionally, but I try not to. Sometimes we do what we say we shouldn't do. But anyway, hopefully this gives you something to think about here. Anyway, thanks for watching and have a great day. Bye.